Hey, it's Richard of Matthews Wealth Management. We are doing the May market update. Today's the end of May, so as of yesterday, Friday, we've got some asset class performance. We're going to cover the May returns, the 3-month and the year-to-date in overall practice. So it's been an interesting upside of a bear market, so let's dive in. First asset class we're going to cover large cap value. Then we go to core and growth. This makes a lot of sense. This is how typically a bull market would look when values are going up. You would see a much higher return on growth versus value, so that makes a lot of sense. For the month of May, we see the same thing reproduced in mid caps from 3, 6, and almost 12, which actually seems a lot higher than the small caps. Small caps are still having a little bit of a recovery issue. A lot of that comes from what we've done in terms of liquidity and lending and so forth for the small guys to recover. However, we still see growth is very far outpacing the value side. International up about 4.5. Emerging markets have not recovered, which is interesting. That's staying a little bit low. If you recall on our big reallocations that we did back in March, we basically dropped out of emerging markets and moved that mainly to international, so that turned out to be good in May. Bonds have really struggled. It's nice to see that everything's positive in the column of May, but that kind of lends the thinking to going to inflation. When everything goes up, it's really a tale of money supply increase. So tips of 30 basis points, long-term bonds were basically flat. You saw the intermediate terms actually doing the best, which doesn't make sense. If you hear of an inverted yield curve, that's a very awkward yield curve there. The longer your bonds should be, the long-term bonds, the longer your money is held up, the higher the interest rate or yield we should see. And definitely that's changing as we're adjusting our interest rates, as well as flooding the market with a lot of treasuries right now. Actually, in May, we came out with a 20-year treasury, which hasn't existed for a long, long time. So the world of bonds is changing rapidly, but the numbers aren't. They're staying about the same. High yield had a good month of 4.4. I mentioned in a lot of emails to some clients here that we saw potentially a lot of downgrading of investment grade quality down to high yield, which we can dive into down the road at some point. But real estate, slight recovery at 2. Gold is still going strong. Oil, we finally saw an idea that maybe 24 bucks a barrel was a little low, and so oil has grown 55% in the month of May. So we knew there was going to be a bounce at some point. Whether or not opening up the economy is really going to increase the demand and lower supply, we actually in the last few days saw that that was not the case, that there was an increase of supply that was unexpected. So that'll just be interesting to watch, but in the long run, obviously oil has to go up for inflationary reasons, if nothing else. The Wilshire 5000, the total market index of 5.5 was for the month of May, and the average 50-50 portfolio made 3.22. So that was May. It was all positive. There's nothing negative. That was kind of the, hey, we've got a vaccine. No, we don't. Hey, we're going to open the economy. I don't know. So everything was going up, which if you follow my emails, I'm not so thrilled about. Anyway, on the 3 months, if we go all the way back to March, where a lot of the downturn was occurring on the front end, we see a very different picture. So this accounts for the gains that we've seen and the correct gains. I mean, to see the 2.5 to 7, that's normal, but let's see how that's played into the 3-month numbers. We're still negative on the value side and a positive 12 on large cap growth. The growth on the large and the mid caps are getting all of the interest. A lot of that, there are a lot of theories going on as to what that specifically could be. A lot of the stimulus money that came in, a lot of unemployment is not being spent, it's being invested. And we see that mainly going into Facebook, Microsoft, Amazon, Netflix, etc. So you see the growth stocks, basically a huge concentration of new investments, and that's pushing these up much higher than obviously the value. So a -2, -12, -15, nobody likes the value side of it. If we're growing, if we're really experiencing a V-shaped recovery, that might make sense. I think we'll see that this creates a disconnect down the road, but equities have been strange. All growths are positive. We do actually have the blend or the core of large cap positive in the last quarter, but everything else is negative and very annoying to look at for me specifically. International, we are down 3.5. Emerging markets down nearly 7. Again, that was a good move we did back in March to avoid the emerging markets, because you can see they haven't really recovered. Then we look at tips, and this is starting to look a little bit better. It's still very flat. You actually see that, that the long term is less than the intermediate term. Again, we don't typically like to see that. We want to see it the other way around there, but short term does make more sense. High yields are still negative, so a lot of these high yields are starting to experience maybe some defaults when it comes to payments on them. How that's going to be structured in the long run, forgiveness of payments or just extension of loan contracts, will be an interesting piece of it, but still down in the last 3 months by 3.4. Real estate down 11%. Real estate prices, I think long term, are going up. Profitability not so much, just because of the costs of doing business there. So still down 11 in the last 3 months. We're up 11 on gold and silver. Silver's finally made a big surge here in catching up to gold, which I'm thrilled about. I was kind of mentioning that in my daily emails, but I don't track silver on the market updates, but silver finally is catching up to gold. But the commodities that are currency hedges are doing well. And then we have oil, which is still down about 60%. In the last quarter, and that takes into account, you know, obviously a very low abnormal demand from shutting down our economy. The Wilshire is a +3, the 50/50 is a negative, which is interesting. So a lot of that has to do with having things in the value side of things, the real estate, high yields, etc., is really pulling that down on the moderate portfolio. So let's dive into the year-to-dates, and we can see the same thing, that just values are getting hammered. The growths are doing well. They're all positive, actually, and -15, 25, 27.5. That's just the weird world of negative correlation in the same capitalization asset class, which it's just the world we're in right now. I don't think we'll see this again unless we do another economic shutdown. But anyway, this is where we are. We're -14 on the international year-to-date, -16 emerging markets. Tips are doing much better, and long-term bonds are doing well, and this is what we expect. Short-term 2.7, 4.6, and 11. That's what you expect. The longer-term bonds to net more interest, more yield, so forth. So high yields are still negative on the year-to-date, and that's just a risk aversion to somebody that may not be in business long enough to make their payments and pay back principal. High yields going forward will be interesting, and we're seeing that start to take place. A lot of that is investment grades being downgraded. We'll cover that more in the June market update once we can see that pan out a little more. Gold up about 14% on the year. Oil year to date is down around 70%. We know that. I won't beat a dead horse there, but Wilshire down 5.17, the moderate portfolio down 5.5. That makes a lot more sense than this one did here. So let's go over to the total practice here at Matthews Wealth Management. I've actually created a new thing. We've got the best short-term portfolio. That's a client that I brought on. I guess that was right at the beginning of March as everything was falling, and they wanted to throw some money in the market. So in that time frame, that client has made 58.44. That's cool to see. Best long-term, these are clients I've had for the long term, where we're implementing a modern portfolio theory strategy as opposed to trying to pick stocks and do well. So that's more of a realistic long-term performance metric, 9.51. And interestingly enough, the worst is a negative 9.41 or 9.51. And then we see the average for the entire practice down 4.41. These are year-to-date numbers. So from January compared to a total market of 5.17 or a moderate of 5.53, actually worse, I'm good to only be down 4.4 across the board. So each client's allocation is very unique to their situation and their targeted goals, but just to kind of show what we're looking at as a practice compared to the overall asset classes. That's the purpose of these market updates. So hopefully this has been helpful. Hopefully June starts to make a lot more sense, and we get more clarification on how the underlying fundamentals of the economy are going to price themselves into the market. Stay tuned. We'll see you at the end of June.